Hi everyone, welcome to the course of International Business. So, in the last few classes we have been talking about the factors affecting international business, and we discussed about factors like culture, politics and legal, right. So, today we will be talking about the economic factors and how they affect international business, right. So, basically we all understand that economy from which this word is derived is economy is basically the optimum utilization of resources, and resources are always limited. So, in any country for that, right. So, there is the factors of production are always limited. So, how one would utilize it if we are looking at the conditions of its people and its stakeholders. So, that becomes very important. So, when a new firm enters into an international market, they need to understand the economy behind this and the different economic factors that impact that can impact its business, right. And I am very proud to say, when I am talking about economy, I am proud to say that one of the Indians has been awarded the Nobel Prize for Economics this year. So, congratulations to him, and let us see what are economic factors and how do they affect. So, economic factors are the factors that affect the economy and includes things like interest rates, tax rates, law, policies, wages, inflation rate, demand and supply, exchange rates and governmental activities. So, all these things are made to run the economy in a better way, right. So, these are the factors which are connected to the economy. These factors are not in direct relation with business maybe, but it influences the investment value in the future, right. So, if the tax rates changes, suppose for example, for certain products, luxury products, the tax rates are increased, or for essential commodities, for example, the government wants to reduce the tax rate. So, what kind of an influence it will have, and what kind of an influence it will have then on the connecting industries, right, the industries who are making those products. So, these are some of the things that are very important, right. And as a student of management or international business or economics, one needs to be very clear with it. Example, who would forget the crisis that has happened in the past, for example, the great recession that had happened in the early 1900, right, 1930s and 2030s. Then we came about the 2008 crisis which we happened, the subprime crisis. So, these were issues that shook the nation, right. Then we had 1999 the Southeast Asian crisis, right. So, in 2008 for example, the worst case of inflation affected the Central African nation Zimbabwe, one of the examples taken. So, although it shook the world, but we are talking about Zimbabwe, how Zimbabwe was affected, and I still remember that Zimbabwe's economy had crashed, and they were producing very large valued currencies, for example, of very high value, right. So, which is not a very good sign. This proved very disastrous for its economy, leading to country adopting a foreign currency as a way of solving the crisis. So, to solve this crisis, they had to depend on some foreign currency. Recently, the Indian automobile industry, in fact, the Indian industry has been hit hard last year and this year, but especially the automobile industry, it has been hit hard due to the slowdown caused by several factors like high GST rates. It was first of all we can say high GST rates, and again the GST was not very clear to many of the players, the farm distress that has happened, stagnant wages and liquidity constraints, right. So, liquidity constraints, stagnant wages, all these things taken together has affected the demand side. So, the demand has been affected largely, and I would take this point to explain that presently the Indian government has used a strategy to uplift the economy. For example, they have slashed the corporate rate, but to me it is not a very wise decision, because you see what happens is when you reduce the corporate rate, the money stays with the corporate and it is expected they would pass it to the customers, but that is not necessarily true, right. So, what happens is you have helped the supply side, but the problem lies in the demand. So, when demand is not growing and demand is has not grown, who would buy these products, right. So, giving a slash in the corporate rate is good enough maybe, but then the demand does not change. So, until unless the demand changes, the economy would not get a facelift. So, these are very important things which the government also has to take into account. So, according to the Society of Indian Automobile Manufacturers, passenger vehicle sales dropped to 2,23,317 units in September 2019 from 2,92,660, right, a year, while passenger car sales dropped by 33%, 33.4%, and the low demand in the recent months has led to a massive slowdown in the auto sector of the country, which is the fourth largest in the world. Now, this is not all, this is not only the automobile sector, there has been a slowdown in the even the fast moving consumer goods sectors. Many companies have cut down their workers. So, there has been a lot of workers been fired and all. So, on totality, in fact, to correct this, the government has changed its policies, tried to support, but things have not seen much of a change at the moment, right. What is the importance? So, from and looking at the examples that we have taken, we can understand that economic environment is very, very vital, right. So, managers should assess a country's economic environment, knowing that different countries have different level of economic development, performance and potential. Economic development is an improvement in factors such as health, education, literacy rates and a decline in poverty levels. Economic development directly impacts the citizens, managers, companies, policymakers and institutions, right. The dynamic nature of political and economic events. So, there is a strong correlation between political and economy, politics and economy, right. If I draw a correlation, I would see it would be very, very high, because the change in policies, the political situation changes, the economic situation can also change, right. Because with the political ideologies, the ideas, the economy also gets affected, right. For example, we have seen in the past, we have taken the case of Myanmar, how Myanmar changed its governance and in 2011, and then from there they started doing better, and in the past they were having a very, very bad time. A country's economic policies are a leading indicator of the government's goals and its planned use of its economic tools and the market reforms. Now, when it comes to economic policies, there are lots of policies, right. For example, the bank purchase rate, the repo rate, for example, the bank constantly been working on it to reduce the interest rates, right. They have been, the Indian government has been trying to infuse more of liquidity, but then still things will not work till we do not attack on the, or we do not foster the demand side, right. We have been trying working hard on the supply, but demand is the one where it is to be worked out. The government of India announced some changes to its existing foreign direct investment on 30th August 2019, which is very recent. These include new norms for single brand retail, coal mining, contract manufacturing and digital media. These are some of the good things that the government of India has done. So, let us see what it has done. So, to make it make India a very attractive destination for foreign investments and boosting employment and economic growth. You see, as we will understand that till employment does not grow, the economic growth cannot happen, right. A product that is made by any company is just an inventory. So, the inventory till does not get a value if people do not consume it, if they do not use it. So, till that time it is of no use. So, how do you boost the employment? How do you pay them, right, that is very important. Anyway, so in terms of the single brand retail sourcing, norms were eased, right. So, now what is the expectation? The more foreign retail brands may set up physical stores in India and establish their online presence too, right. 100% FDI allowed in contract manufacturing. So, electronic pharma firms are likely to set up manufacturing facilities in India. This is the hope, right. 100% FDI in coal mining through automatic route, right. So, automatic is the government route, right. So, monopoly of Coal India likely to end. Move will help create an efficient energy market. This then the 26% FDI limit extended to the digital media. This again brings in a hope that new services on par with print would be and allows would grow up and it would be valued separately. So, these are some of the changes the government has tried to do, thinking, hoping that it would help in boosting the domestic market, helping more the investors to come in and start their business, and finally boost up the employment and do good for the economy as a whole, right. Some key terms that we need to understand when we talk about economy. For example, GDP. What is GDP? Is the total market value of all final goods and services currently produced within the domestic territory of a country in a particular year. So, all goods and services, right, currently produced are comes under the GDP, right. Now, what is GNP? Is the market value of all final goods and services produced in a year, right. It includes net worth income from abroad. Now, this if you see what it was saying here in GDP case, if you go back, so it says it includes only final goods and services. It includes the value of goods and services produced within the domestic territory. So, anything done outside was not there, but here we are including the income from abroad. Net national product at market price is the market value of all final goods and services after allowing for or factoring for the depreciation, the wear and tear, right. National income is another term which is important, which we will be using frequently, is the sum of the wages, rent, interest and profits paid to the factors for their contribution. Factors are like land, labor and capital to the production of the goods and services, right. Finally, personal income is the sum of all incomes earned by an individual or individuals households during a given year. Certain incomes are received, but not earned as old age pension, etc., right. So, these are some of the terms that we will be using frequently, and maybe we will look at it more in detail. So, international economic analysis. So, what are the factors, what conditions impact? Let us see. Some conditions that hamper the development of a universal scheme to assess the performance and potential of a country's economic environment. The first one says difficulty in stipulating a definitive set of indicators to estimate the performance and potential of a country's economy. Now, let us see with an example. Suppose there are two countries, and these two countries the national income is increasing at the same rate, but in country A population has doubled, whereas population remains the same in the country B. So, what has happened? National income has been increasing in the same rate, but here the population has doubled and it is same here. In that case, the per capita in the income in the country B will reduce to half as compared to country A. The national income measure will put both the countries the same economic level, but per capita income would indicate country B as more important than country A, right. Therefore, we are required to know both these measures to assess the economic development effectively or accurately, right. So, what is the right indicator? So, that is very important to do an economic analysis. Another thing is that set of perfect measures may prove imperfect tomorrow. So, what is today a perfect measure in a particular condition might not be a perfect measure tomorrow, right. So, a new measure has to be checked in a different condition. Then interdependencies complicate the interpreting the relationship among elements. So, a relationship interrelationship between GDP, GNI, PPP and HDI, right, Human Development Index also creates a confusion, and finally, the data overload complicates the decision making for the managers, right. Now, look at this case again. Gross national income per person figures can be misleading. Why? Because they do not consider differences in the cost of living, right. So, for example, although the 2018 GNI per capita of Switzerland at this much dollars exceeded to that of the US, which was this much, the higher cost of living in Switzerland meant that US citizens could afford almost as many goods as the average Swiss citizen. So, although you had a higher GNI in Switzerland, but because of the higher cost of living in Switzerland, the Americans were at the same parity, right, as the Swiss people. So, the elements and indicators, so as I said, we will be explaining. So, the gross domestic product, what it says, the total value of all goods and services produced within a nation's borders over 1 year, no matter whether the domestic or foreign owned companies make the product. Who makes it is immaterial. Anything that is made within the boundary of the country comes under the GDP, right. But interestingly, I will tell you. So, let us see, for example, US remains the top economy with a GDP of 20.5 trillion in 2018, right. India has been pushed to the 7th place in the global GDP ranking in 2018. So, you can see here India is here, US is 20.5. So, India is only at 2.7 trillion, right. But we have grown with time, but then it is not sufficient. But interestingly, there are some controversies with GDP also. Some economists think that GDP, and I too agree to that GDP may not be a very strong indicator. GDP does not account into things like the value. For example, let us say we cut a tree, right, and we sell the wood, right. Now, when we sell the wood, the price of the wood maybe becomes a part of the GDP. But what happens to the loss that happens because of the kind of oxygen that was being provided by the tree to us, the shade that was being provided by the tree to us, and other kind of benefits that was being provided, right. So, all these benefits, where have they gone, right. So, that has been not valued, that has been not monetarily valued, but then had they been monetarily valued, maybe the GDP score would look different for any country, right. GDP is especially useful for assessing countries in which the output of the multinational sector is a significant share of activity. For example, almost 90% of the Irish export are made by foreign owned firms and not the local ones, right. Okay. Next is GNI, the income generated both by total domestic production as well as the international production activities, right. So, GNI is the value of all production in the domestic economy plus the net flows of factory income from abroad during a 1 year period. So, look at it, the per capita income at current prices during 1819 of India is estimated to have attained a level of rupees 1,26,406 crores, right, or this much monthly, as compared to the estimated for the year 2017-18 of rupees 1,14,958, right, showing a rise of 10%, right. According to the annual national income and GDP data released by the Ministry of Statistics and Program Implementation. The gross national income at current prices is estimated at rupees this much during 1819, right, as compared to 169.1 lakh crore during 18. So, this is again a rise of 11.13%. India's gross domestic product is estimated to have slowed to a 5-year low of 5% in March 2018-19, mainly due to poor show in the farm and the manufacturing sectors. So, what has happened? Although if you see the national income is this much here at 1819 as compared to 1718, it was 169, which has risen, right. But now at this moment, right, India's GDP has slowed down to a 5-year low. Now, this is something that one needs to understand that what is the relationship and how this interrelationship matters to anybody, right, to a basically an business firm, and it is for all the, in fact, the the critics, the business firms and everybody. So, now this slowdown is something that is very bothering for India, right. Now, let us look at the gross national income per capita shown for different countries. So, in terms of ranking, if you can see, right, Switzerland stands at the top, right, and this is for the gross national income, and this is for the purchasing power parity. India's ranking is 144 in terms of the gross national income, and India's ranking in terms of the purchasing power parity, it is 126. So, there are two ways you can understand. One is the GNI per capita, right, which is measured through the one method called the Atlas methodology and the purchasing power methodology. So, if you look at these two methods and see that India stands at a very low place, it is at a very bottom, right, and if you look at the purchasing power parity, what it says is basically Qatar is at the number 1 position. So, these are some of the things that impacts. So, what it says, purchasing power parity is an international dollar has the same purchasing power over GNI as a US dollar has in the United States. So, basically purchasing power parity helps you to tell with the same amount of dollars in a different place how much you could have purchased, right. So, this is some of the and the if you look at the lowest rankings are somewhere, for example, Burundi is at the lowest rank, right, and Guinea, these are some of the countries which have a very low rank in terms of the gross GNI, right. Now, how do you improve the power of GNI? GNI can mislead managers when they compare countries, right, it can be misleading because you are adding several factors into it. Therefore, managers improve the usefulness of gross national income by adjusting it, this is very important, for the number of people, the growth rate and cost of living. If you do not adjust it with these 3 parameters or the 3 factors, then it becomes a misleading data, right. Now, what is per capita conversion? A nation might have a high rank on the basis of GNI, example Germany and France for example, but rank only in the middle on the basis of GNP, right, per capita. So, in fact, China, which is the world's second largest economy according to GNI, ranks 71 in middle tier of countries according to GNI per capita. So, if you take absolute GNI and if you take GNI per capita, these figures would be very different, right. So, the business firms needs to understand ki whether they are interested for the GDP, the GNI per capita, what are they interested in, because that is what matters to them, right. So, the per capita indicators help to explain an economic performance in terms of the number of people who live in that countries. So, if your per capita income is high, that means the people can purchase your products, right. So, there is a chance of doing better in that country. Rate of change. Interpreting present and predicting future economic performance requires pinpointing the rate of change, right. Generally, the GNI growth rate indicates economic potential if GNI grows at higher rate than the population standard of living and are said to be rising or falling, right. So, what it says is it should grow at a higher rate, right. So, if the GNI is growing at a higher rate, so the gross national income, right, we will say that the economy is doing better, right. Purchasing power parity, the calculation of GNI per capita does not consider the differences in cost of living from one country to the other. So, managers adjust GNI per capita for particular country in terms of its PPP, right. So, in comparison of Switzerland and Qatar, you can see as in the table we had shown, GNI per capita in terms of relative PPP is higher in Qatar because of the lower cost of living. So, again you can see here, so Qatar has 124,130 and this is purchasing power parity and this is only 83,580, right. So, these are the things that business managers must understand deeply, and they should also understand how the currencies are fluctuating, how the local governance, the tax rates are changing, how for example, the RBI is trying to do it in India for example, or the federal does it in US, right. This is the last thing we will talk about today, the degree of human development. Now, degree of human development also has a great relationship with the economy condition, right. So, what it measures is basically the quality of human life, right, in terms of both economic and social. To estimate its current and future economic indicators that enable managers to more fully measure development in terms of the capability and opportunity that people enjoy. The HDI combines indicator of real purchasing power, education, secure livelihood and health, right, to measure the economic development. So, what it says, HDI is an index that is used to rank countries based on human development. So, indicators including expectancy, life expectancy, how much one would live. So, the life expectancy has been growing in India with time because of better medical facilities, better opportunities, right. The per capita income and education are used to rank the nations. Okay. Nations that rank higher on this index have a higher level of education, is generally higher lifespan and a higher gross national income per capita, right, than the nations with a obviously lower score. So, this is how it looks like. So, the UNDP, right, Human Development Report ranks countries on basis of measuring human development by combining indicators of a long and healthy life, access to knowledge and a decent standard of living into a composite score, right, of HDI. the 2018 report classifies 189 countries into 4 broad segments: very high, high, medium and low, right. So, let us see this ones which are very high development, right. So, it starts with like Norway. So, it ranks between 0 and 1. So, Norway 0.953, Switzerland 0.94 and Russia is 0.816. So, these are some of the very high development ones, and this is a very recent data, right. And in terms of high development, it is Iran, Mexico and till Ukraine, right. Medium development comes where the score is like 0.6 around 0.6 to 0.5. So, 0.55 and 0.7 in between that. So, Philippines, Egypt, Indonesia, India, Pakistan also lies at the medium development, and in low development you have some of the African countries and which have a very poor score, right. So, these are some of the things, the components as it says, right. So, which I have said: mean years of schooling, expected years of schooling, gross national income per capita, expected life expectancy at birth, all these are the different indicators, okay, components. So, between 1990 and 2017, India's HDI value increased from 0.427 to 0.64. This was a very good sign, an increase of nearly 50% and indicator of the country's remarkable achievement. So, this is the time, if you can remember, 1991 when India had gone for the LPG scheme, right, liberalization, privatization, globalization, although there are several criticisms against it or for it, but I am a stern supporter because at that point of time which India was going through. So, at that point of time that was a great savior for the Indian economy, right, lifting millions of people out of poverty according to the SDI report released by the UNDP, right. Between 2012 and 17, Libya, the Syrian Arab Republic and Yemen had falling SDI values because of direct effect of violent conflict, right. So, this is something you can see it from here, right. So, now this is the one which we are talking about. So, the human development index, how it has been shown now 2017 HDI. So, this is the number of people. So, very high human development, medium and low human development, and this is the scores, right. The height is the score basically. So, as you can see, the height of the slides reflects this HDI value and this is the population, right. So, how much people are there? So, you can see from here the global population increased from 5 billion to 7.5 billion in this time period, right. The number of people in low human development fell from 3 billion to 926 million, or from 60% of the global population to 12%. So, that is a very good sign, right. The number of people in high and very high more than tripled from 1.2 billion to 3.8 billion, or from 24% to 51%. So, you can see that because of the trade, because of the international business, the more economic achievements are there, the policies are favorable, the countries open up. There is no doubt that and with education and all, the economic condition, the social condition in the countries are growing, right. So, we can say for an instance that international trade, international business has a vital role to play in the growth of a nation, right, and countries who are still doubting it and trying to stay in isolation would suffer from it maximum, and they would not be able to join the momentum and gain the advantage, take the advantages. Yes, criticisms are always there, but it has been seen empirically that this has had a tremendous positive achievement and success on every country. And yes, the poor have been poor, but they have not become more poorer, which is the criticism that generally done, right. They have been poor, yes, they have been not able to exploit the situation in a way as maybe the developed economies have done, but it does not mean they have become still poorer, right. And so, we can see that these are the factors that affect it, and every country should try to take as much as advantage as possible, which India has done. And we can see, and even when I am again finishing my today's lecture, Abhijit Banerjee, who has been given the Nobel Prize for Economics with his wife Duffler, has talked about, his study has been on an experimental analysis of poverty elevation, right. So, here again they have studied how poverty elevation can be done, right, with some good economic policies and rules and regulations, right. So, this is all we have for the day. Thank you very much.